Let's start with what's going on with yields. Yields really trying to bounce again today. And this is not just a US story. Of course, we were without the US yesterday, but we are seeing it in treasuries today. We saw it in the European bond market story yesterday, where we got some quite hawkish pushback from various ECB officials. Is that what's driving this recent bout of questioning the rate cut story?
I think that's certainly helping the dynamic here. But the context is that after that PPI last week, we really kind of fell to very low levels, particularly in the front end in the US. And we're suddenly pricing in very aggressive rate cuts, which at the moment still aren't validated by the kind of consensus on the economy. Remember, it is unlikely that we're going to get the 6 rate cuts and yet have growth hold up. So either we need to suddenly have much worse growth data, and maybe it turns out that we're going into a recession or going very close to it, and that would justify the rate cuts, or we're going to need to pare back those rate cuts. So I think that overall, the dynamic of how low we've got at the front end is unsustainable. Sure, it was helped by the rhetoric, but I think the dynamic going to March is, unless the data changes drastically, we're going to start seeing some of those rate cuts priced out.
OK, and thinking about where we go on the rate cut story, thinking about the UK geography, we got wage data out earlier on today, which perhaps moving in the direction the Bank of England does want it to, and perhaps reinforcing expectations that we are able to see cuts in the UK. What did you make of the wage data we got at the top of the hour?
Look, I think this kind of backs the idea that the Bank of England could perhaps go ahead of the ECB. The whole narrative for the last while is that UK has much stickier inflation and much more of a stagflation dynamic than Europe, and Europe would have to go first. But ultimately, I think that inflation is also coming down quite quickly in the UK, and therefore there's a chance. Normally the ECB is behind the other central banks in the cycle, and I expect that to be again the same case here, where I think even the Bank of England can go ahead of the ECB, and the Fed most likely will as well. So I think it's going to change the order of the central banks, but most likely they'll all still move in tandem.
OK, interesting. Yeah, the pound is moving lower, but that's partly the strong dollar story, isn't it? So it's down 0.5%. If we look at rates markets, Bank of England rate bets are steady, actually, after this UK data, so not really changing the market's perception, it seems, as far as rates are concerned. You've done an interesting Markets Live survey, I know, Mark, which has asked about how investors and those who are looking to retire anytime soon are trying to beat inflation or to secure their portfolios from the risks around inflation. And a lot of the answer seems to be in stocks.
Yeah, absolutely. I think this is the main takeaway is we're trying to look at what the impact of changing demographics, the aging populations around the world, on kind of savings trends and how that impacts on assets. And one of the dynamics that we're seeing is that people are expected to be retired for much longer, essentially are changing their portfolio to have a much greater exposure to stocks than was the case in the past. And this might mean that there's a structural headwind for bond buying in the future, which is obviously quite problematic in a world when deficits are still kind of going up. We're seeing that the US increase its fiscal deficit particularly.